Hey everybody, here's your weekend market minute for Sunday, the 20th of August. Here's the S&P 500 with the monthly, weekly, and daily from left to right. Now, up until Wednesday, everything was going just fine. We had noted that with the weekly chart in exhaustion, the price pulling back made the most sense because we had a daily chart totally charged up and had to move somewhere. Could have gone to the upside, could have gone to the downside, but right now, or as of last week, the weekly chart was still just coming out of exhaustion. So the path of least resistance was to the downside. And what tipped the boat was really the Fed minutes, believe it or not, on Wednesday afternoon, as many of the members inferred that more rate hikes were coming down the road, which kind of it beats the narrative that we're just about done. So, of course, bond yields continue to go higher, and this is going to put pressure on risk assets, including especially tech. Tech is really what led to the downfall in the latter part of the week. So we had a little bit of a black swan into the end of this week. Now, the S&P is only down 5.9% at this point, which is a pretty typical little reaction after a very strong move. So this is very similar to what we went through back in March on similar circumstances where we kept getting negative information impacting the market. Eventually that bounced from there and led to new highs. So this is all very normal. This is all very normal, especially with a weekly chart, which has just gone up way ahead of itself. We still have lots of energy left in the monthly chart. Still have a weekly trend to the upside. We're expecting some type of a higher low. So everything is normal right now. It's just that the Black Swan showed up late last week and accelerated the pullback. And also you're seeing this accelerate the recharging of this chart. Notice what's happening now. We have a daily chart and exhaustion to the downside. So at some point we're going to get the bottom of this move. We're going to get some type of reaction back up. So that wherever this lines up, and I'll talk about potential targets in a second, what we're looking for is maybe in the next week or so, we might see a bounce back up. Now, that is really what I'm interested in, because is that going to bounce up to a lower high and roll over again? Is that what we're going to be in store for? Or will we see the price bounce here and then keep on heading higher and shoot for new all-time highs into the fourth quarter this year? So we don't know the answer to that just yet, but that's the game that we're going to be playing next. So short term, we're going to figure out where this thing most likely is going to find some support. So let's go through some standard tools that are out there for technical analysis. One of the simplest is just round number support. And you'll see that former resistance here at 4,300, it took a while, it took about a week for us to get through that line. Former resistance becomes new support. So the 4,300 level should be good support on the S&P 500. Now what we need to do is to find confluence. Confluence is important, and this is where we look for things like fib retracements. So we're going to take this swing all the way back to the middle of March and go up to the recent highs here. And what we're going to find is that the 38.2 retracement, which is a very common pullback level, lines up almost precisely with 4,300. So once again, this is starting to stiffen up that level. And the price is maybe only 40, 50 points away from hitting that, which is a good day's worth of work. Something else that we can look at is the standard good old Wells Wilder RSI. And right now it's at 34. So the classic level for being oversold, seriously oversold, is down at 30. Now, we haven't seen that for almost a year. We haven't seen that level down below 30 for almost a year, but you can tell that quite often the price will bounce as it gets very, very close to the 30 level. And we've seen bounces like last March, it got down to about the same level, 34, and it bounced right there. We haven't seen anything close to that since March, but there we are. So right now, in between 34 to 30, so technically, from an oscillator perspective, this is just about oversold enough to call a bounce for this. And the fact that it's happening near 4,300 is also important. The next one is somewhat of a more obscure oscillator, which is called the McClellan oscillator. So this one goes all the way back. We can look at this years ago to some of the recent sell-offs, like in early 2018, we got this thing down to about negative 360. So that one's all the way down over here. So negative 360. And then we've had, of course, the 2020 pandemic had a huge negative number. But since that point, again, last September, this got down to about negative 4, looks like about 417 or so. That's pretty severe, but that was still during the bear market. In fact, that marked the bottom of the bear market in terms of capitulation. So the March low got down to about negative 330. Now we're not quite down to that level yet. So if we're looking at this oscillator, comparing this low, negative 330, we almost got down to that level, but not quite. So do we need to go further down to there and show, or is that going to show some positive divergence if we do go down to 4,300 and this does not make a new lower low on that oscillator? That could actually be a positive thing. The last thing I'm going to bring up is the Bollinger Bands, which is in the upper pane here. Now, the price is below, or it was on Thursday, it was below the lower Bollinger Band on the daily chart. And so that's usually a good signal for that, although the MACDs are still heading lower and there's no positive divergence yet. Probably a better signal for this is on the weekly chart. If we got to the weekly chart, we can see that the center of the Bollinger Bands, in the case being the weekly chart, this is a 20 period or 20-week moving average. And notice how well that the price, during a primary bull market, the price is supported at this 20-week moving average very nicely. Now, sometimes it's clean and sometimes it will undercut. It's a pretty dirty low. But still, nonetheless, that seems to be really good support during a primary bull market. And we're almost there. So right now the price is showing that 20-week moving average. Now this is going to roll over as of tomorrow where we print a new candle. But right now it's sitting at 43.16. So all signs to me show right around the 4,300 level is a potential bottom. Now the price can turn around and start running on Monday. That's fine. But if the price comes down just a little bit more, I think there's a massive amount of buying support at around the 4,300 level on the S&P. So after that occurs and we start seeing some strong green candles, then we're going to focus on what happens next. So wherever this bottoms out, whatever happens next is going to be extremely important, because it's very unlikely that this is going to just bounce from here and go straight up to new highs. We are going to more than likely have some kind of reaction along the way to build that scary higher low. And that is going to be the most important point that happens in the next few weeks. Probably going to happen sometime in the month of September after we get this bottom put in. We get some kind of relief bounce, some kind of oversold bounce. And then the games begin, and this is going to go right into September, and this is where we usually have some of the more important moves of the year. All right, folks, that is it for today's Market Minute. Have a great weekend. We'll see you back here in the next one.